All right, guys, welcome to the channel. My name is Anthony LaBorde. I'm a real estate agent here in Atlanta. In this video, I'm going to introduce my buddy Dave. He's my go-to lender here. He gets questions all the time about the lending process, getting approved, etc. So we've been throwing around some ideas about doing a series here. So we're going to get started today. Dave, first of all, thank you for joining me. Appreciate you getting on the broadcast here. Go ahead and introduce yourself. Tell me a little bit about your background, like where you're from, how long you've been in the mortgage industry, and we'll take it from there.
Yeah, thanks, Anthony. Thanks for having me, and hello, everybody. It's a great day, and here to talk about loans and real estate and how to make people, get in a good place to buy a house. So a little bit about myself. I work for a company called Stockton Mortgage, where my office is in Duluth. I live in Roswell, but it's based out of Kentucky. We're a pretty large company, but the office I work for, we're just a loan machine, right? So we do a lot of loans and we help a lot of people. So a little bit about myself. I've been in the mortgage business, around 8 years now. Retired full-time fireman. I used to work for the city of Atlanta. I did that for almost 13 years. Just recently retired in March. So it's nice to be, I have one full-time career, not two. So I'm very excited about that.
You miss firefighting at all?
I miss certain parts of it, the camaraderie, the guys, the cool calls, but it's a stressful job. You see a lot of bad things, and it's fun, right? I mean, not the bad things, but just the intensity and being able to help someone in need is a great feeling. But it's taxing on your body, it's taxing on the mind, taxing on your home life. Right. I'm gone a lot. So the fact that I'm home all the time, I'm married, one beautiful little girl. She's an 8-year-old, so she needs me around more. My wife needs me around more. So just being home more and being more of a dad and a husband is very rewarding. But I miss a little bit of it.
So Dave and I actually met a while back. One of my other clients, Chad, if you're watching, Chad Mickens, he's a firefighter as well. We had a deal going on together. It literally was just falling apart. Tiffany, was Chad's wife, had suggested, Dave, hey, I know a guy that can clean this. They came in and moved stuff around and worked wonders. And then from then on, I said, this is my guy. And he's just an amazing lender, man. I appreciate all that you've done for me and my business. So again, appreciate you being here. So I want to jump right in. And what I first want to talk about is, when somebody calls me, they call me, they're interested in a house. We go through the process. What are you looking for? Yada, yada. One of the first questions I ask them is, have you talked to a lender? Have you been pre-approved? How are you going to pay for this? Number one, if it's not cash, you're going to be financed. You need to be pre-approved. And so we talk a little bit about that. One of the questions that I get back is, what's the difference between pre-approved versus pre-qualified? They are two different things, and I want to give Dave a chance to kind of elaborate on that. So.
We throw those terms out all the time, right? I mean, are they interchangeable? I mean, not really, right? So being pre-approved is having the loan officer evaluate everything, go through pre-underwriting, and get the approval, right? So if you send me a client, or a client calls me up and says, Dave, I want to start that process. Well, that first process is filling out an application, right? So once they fill out that application, I could look at it, determine, be like, hey, you're pre-qualified for a home loan. Send me your documents, send me your W-2s, your tax returns, whatever it is, okay? Once I get all those documents back, I evaluate it, I run it through an automated system, or even maybe send it through an underwriting, right? But once I get that pre-underwriting approval, I can consider that now pre-approved, okay? So the difference between pre-approval and pre-qualified, pre-approved is the next level. And it's just the client providing all the documentation needed to get to the even next step, which is the underwriting process.
So you can actually be pre-qualified and not be approved, like eventually lose the chance at getting the loan. Sure. So they are, one's a little bit more important than the other one, right?
I would agree so, yes.
Yeah. So another question that I get, so they go through the process. Another question I get a lot of times is, hey, I have bad credit. Maybe I have, and they usually don't talk about the scores, but they have bad credit. They need to get their credit up to be pre-approved and pre-qualified. What are some things that somebody can do early on when they're thinking about buying a house, preparing that process, that they can start building their credit back up? Maybe they had some dings in the past. Are there anything they can do to get ready and then talk to you and move forward?
Well, yeah, you always need to be prepared, right? So if you're just talking about credit, number one, pay your bills on time, right? That's without saying, right? So it's very easy to lose credit. It's very hard to gain good credit, right? So, you can do so well for 2 years and have one little, mess up. And, you're not taking 2 steps back. You're taking 5, right?
And correct me if I'm wrong. That one little D, it's like somebody is late on a payment. That one late payment can be catastrophic to them sometimes.
Yeah, it could. It could be the difference between being approved and not, right? And, if they're starting out at a 640 credit score and it goes down to 590, well, it's in a bad. If you're at a 740 and you get hit, if you go down to a 700, you're still approved, but it does affect the overall credit profile, right? So, which is effective, which is going to have an impact on your rate. Okay, so a lot of moving parts and a lot of pieces are attached to that credit score. So we want to make sure that our credit is in the best possible position for when you're ready to buy a house. So how do we get there, right? Obviously, pay bills on time. We want to see available credit. That's what drives the algorithm. So a credit score is just an algorithm, right? So, and I may jump off a little topic here and just get ahead of ourselves, but there's 3 credit bureaus, right? You got TransUnion, Equifax, and Experian, right? Essentially, they're 3 separate companies, right? And all they do is collect data, right? Now, why are there 3 different scores, right? Well, because they're 3 separate companies and they have 3 separate algorithms. That's why you have a variation of a score. So, what is involved in that algorithm that drives the score, right? Well, clean payments, on-time payments, available credit, right? So have a $300 limit and have a $300 balance. Well, that's considered being maxed out. That's going to drive that algorithm to drive the score down, okay? So we want to have available credit. So you want to have a lot of availability so your high limit is as high as possible, which means having an accessible amount of 10 grand, 5 grand, 3 grand, right? No matter what it is, with a very low, under 30% dollar amount that you owe, right? The lower you have, the better it is. We try to keep all our balances under 30. Even a sweet spot is they say 9% is that sweet spot. It's better than owing 0 because it is something. But you want to have low balances, high limits, which is available credit. The longer you have something, a trade line, we call them, the better off they are in the algorithm. That's why we say never close a credit card. The longer you have something, the more valuable it is to the algorithm.
And always keep a small balance on there?
I mean, sure. I mean, if you're trying to really drive your credit score up and maximize it, keep a very small balance, right? I personally just pay my bills off at the end of the month, right? And
see, that's what I've always done. And now you're telling me, I'm like, wait a second, should I have $5 on there, $10 on there?
If you're trying to increase your score by 5 or 6 points, yeah, that's the difference, right? If you're like 740 and above, then it really doesn't matter, right? If you're at a 640 or 660 and you're trying to squeak out a couple extra points, yeah, run a small balance. Okay, 9% is that sweet spot, right? But for long term, I tell all my clients, pay it off at the end of the month. Right? Yeah. I don't care about your credit score today. I'm trying to get you in 9 months from now, right? Yeah. In 9 months from now, I will. And if we're trying to tweak that credit score, I'll say run a small balance, but in between, pay it off, right?
What's the smallest score? I'm getting off subject a little bit, but I'm curious. What's the lowest score somebody can come to you and you can move forward with them, get them qualified?
Well, FHA requires a 580 credit score, right? So I would say 580. Right. Okay. But that doesn't guarantee you getting a loan, right? There's more to it than just the credit score. It's a lot of times the why. You may have a 580, but I'm not going to get an approved eligible in my underwriting system, right? Okay. It's just about the why. Where's their late payments? Okay. Are there collections? Are there judgments? Or is it just, hey, you just don't have enough credit? You could be a 21-year-old, young lady or man just starting their credit and you just don't have enough. That's different than $17,000 in a repossession or a collection, right? So it's sometimes the why, but to answer your question, it's 580 for an FHA loan.
But you guys have the ability to see the why, like you can say, okay, it's late payments that caused this, or okay, and then that will affect how you determine yes or no and moving ahead is the why.
Absolutely. When I pull a credit report, I'm not just getting the numbers. I'm going to get each trade line and their history on that trade line. Mm-hmm. If there was a late payment, they're going to tell me, it was late in January of 2020. It was late in October of 2021, et cetera, right? Yeah. So it tells me how many lates there are, if there are collections, who the collection agency is, how much they owe, and when that collection was reported. If there's judgments or state tax liens or federal tax liens, any type of judgment that comes up on the credit report, I have to evaluate that. Your loan officer has to take a look at that, because you could have a 720 credit score and judgments. Your judgments have to be satisfied before the closing. So very important. So we're not just looking at a score. I'm evaluating the entire report on every single credit report I look at.
Yeah, and again, I'm taking this off script. I'll come back in a second to what somebody can do to build their credit score. But a FICO score, can you explain that? Like, what is a FICO? I've had this question before. Like, what does that even mean? Is that my score? And I guess elaborate on what is a FICO score.
Well, I love this topic, right? Because people ask me all the time. I'm looking at my FICO score. It's 730, but you're telling me it's 690. Well, there's different models of FICO. FICO is just a credit score, right? So, but there's different models, right? So the mortgage business uses FICO version 2, 4, and 5. And that represents Experian, Trend, Unit, Equifax. I don't know which one's which, 2, 4, and 5. That's what we go by, okay? I don't care if you use myself, the big box banks, it does not matter. Mortgages, we use that across the board. If you go get a car loan, it's FICO number 7. Go get a credit card, FICO number 8.
And that's going to be different. It can
all
vary
be different because of the algorithm, right? Remember, everything's an algorithm on these credit reports, okay? So now, why is it different? Well, mortgages are the most riskiest. So we're going to look at everything, okay? Where if you're going to go get a car, some of those collections that are reported, well, they're not even being reported into the algorithm because they're not as risky of a model than the mortgages. Credit cards is the least riskiest because they'll just give you money, right? Yeah. So people say, hey, I'm looking at my Discover card right now. I got an 816. Why do you say it's a 740? Well, you're looking at a totally different mortgage FICO model than the mortgage process. Now, I'll even get you on another one. I love, people say all the time, Credit Karma.
I hear it all the time. Yeah.
It's not even a FICO. They do not use FICO. And there's such a gap.
You're lying, Dave. Credit Karma said.
Nope. They're not a credit reporting service. They're great for evaluating what your credit report looks like today versus tomorrow. So if there's a change in your report, it's a monitoring service. They'll let you know, right? They don't even use FICO. So which is why there's such a gap between the FICO score and their score.
And this is another video altogether, but it's the same amount of time that I get. Well, the Zestimate says my house is worth $500,000. Well, no, it's not.
So let me ask you. I'm going to answer your question. What you had before is that how does someone build credit without credit, right? If someone's got a 620 credit score or a 610 credit score, be like, I can't. No one's going to give me a credit card, right? So how do you build it? Well, you can go get a prepaid credit card. If you have a banking institution and you belong to any bank, I don't care if it's the credit union, Wells Fargo, Bank of America, it doesn't matter. Whoever holds your money, they will give you a credit card if you prepay it. Okay. It gets reported to the credit bureaus just like a regular credit card. I have no idea when I look at it. I can tell just because I've been doing it long enough because of how much of the limit is. $300 limit, $500 limit. Usually those are prepaid credit cards. Mm-hmm. But again, the algorithm doesn't know because it's being reported as a trade line through the Bank of America for $300 and you owe $80. That's all it says. It's a revolving debt. So go get one, go get two, go get 3 of those, right?
And they'll give you as many as you want because you're paying in advance. Has nothing to do with the credit score. Right? Yeah.
So go get one. And I always tell people this. Go get one, use it for gas only. Go get another one, use it for food. Okay. Every time you get paid, pay it off in full. It's kind of like swiping your debit card, right? But instead you're establishing credit. Now you have 2 trade lines, right? Use them after 6, 7, 8 months. Those are going to be valuable. And all of a sudden your score is going to increase, right? To the point where those credit card companies are now going to start giving you letters in the mail that they'll give you one. So if you went to Bank of America and you opened up a prepaid credit card and you prove to them after 6 or 7 months, they're going to give you a real credit card with a bigger balance.
Yeah.
$1,000. You know, pay a couple more months on that, 6 months. You call them back, be like, listen, I want you to raise my limit. Now all of a sudden that you started out at $500 prepaid, you had $1,000 with the unsecured, right? Now you can say, hey, I want $2,000. Now what did you just do? You just created available credit, which drives your score up. That is how you start from nothing to get to a good score. That is how you drive it.
Would you say that's probably the most effective way? The pre-approved cards or the secure cards, do it that way, and then of course paying everything on time and everything else. But
if you're starting from scratch, 100%.
Okay. Awesome. Before I forget, and I have some stuff rolling down at the bottom of the screen, guys, if you have questions for Dave, dflashner@stockton.com. There's his cell phone. Shoot him a text. He's super busy, so he may not answer the phone, but shoot him an email if you have any questions at all. One of the things we'd like to do moving ahead, and hopefully Dave will agree with this, I want to do some more videos, answer a lot of questions. We bring up Credit Karma. We've talked about that's a completely whole video by itself. Breaking down the different loan types, FHA versus VA versus conventional. That's another loan type. So I want to do some more videos like this and really educate my audience and anybody looking for loans, to watch this and learn more and hopefully reach out to me and or Dave. But Dave, anything else you can share that would be beneficial to somebody maybe just starting to look for a house? Maybe it's a first-time home buyer. This brings up a great question. So I saw another video where you were talking about this, and I've seen some other ones, like what defines a first-time home buyer? Because many people are like, well, I bought a house 20 years ago. I can't buy another one again. So I think there's a definition there. Clear that up for me if you don't mind.
You've been watching my Instagram page. So first-time home buyer, right? So
and plug your Instagram and stuff when you get a chance. But go ahead.
Yeah, got it. So first-time home buyer, right? It's a term that we throw around all the time. Everyone, I'm a first-time home buyer. What it means is someone who hasn't owned a home in the last 3 years. Okay, so
stop right there. So because that's a big deal to me. 3 years is not very long. Like you can blink and 3 years are gone. So if I bought a house 5 years ago, I can be a first-time home buyer now, right?
If you sold it 3 years ago. Right?
Got it. Okay.
So you can't be on title for 3 years, right? So, the video that I did, I used I said, Grandpa Norman. He's actually my grandfather. I love throwing my, rest in peace. Big Norm was a smart guy, but if you bought a house 10 years ago and sold it 7 years ago, okay, and you have not been on title for the last 3 years, you're a first-time home buyer again.
Wow.
You can be a first-time home buyer 5, 6, 7, 8 times in your life, right? It's you have not been on title for the last 3 years. Now, what does that get you? Okay. It gets you access to maybe certain loan programs, okay, like down payment assistance, okay? So FHA, you don't have to be a first-time home buyer. You just got to call it a primary residence. Conventional doesn't make a difference. USDA, don't have to be a first-time home buyer. You just got to make it your primary residence. VA, you don't have to be a first-time home buyer. Just got to make it your primary residence. So being a first-time home buyer has nothing to do with those loan programs.
Interesting.
Being a first-time home buyer, you may have access to some type of down payment assistance, right? But a lot of restrictions. That's another topic that we got to talk about, right? Yeah. So not everyone has that. If you're doing a 3% down conventional loan, right? Conventional normally has a 5% down payment, right? You can do a 3% conventional loan, but you got to be a first-time home buyer. Right? Now, there is another loan program called Home Ready that is specifically for Fannie Mae that you don't have to be a first-time home buyer, but there's income limits on that, right? Yeah. We can break that down another time. But for the conventional 3%, it's got to be a first-time home buyer unless you have an income restriction. So It really doesn't give you that much being a first-time home buyer. It really doesn't. Right?
Because the perception is it does. Like I get it all the time. Like, oh, tell me about all the first-time home buyer programs that are out there and the benefits. And you're saying there's not a ton of them out there. Huh?
Not a ton, right? Again, it's primarily for some type of grants or down payment assistance, but they're very strict on income, very strict on debt to income. So there's got to be strict guidelines on there. And there's caps on there, right? This market, especially in Georgia now, right? And I know this is being blasted throughout your YouTube channel. So it's, a lot of different people are seeing it. But the market for $200,000 and less and under homes, they're just not there anymore, right? Yeah. So a lot of these first-time home buyer programs where they provide assistance, they were driven years ago for low-income housing, right? $150,000 house, $160,000. They're just not out there anymore, right?
So if they are, and what I'm experiencing, if they are, you're up against cash buyers, you're up against investors that are going to come in and they'll snack it up like that, and you have no chance at it.
And I'm not saying they're not good programs, and there's certain people out there, of course, right? So, but it's not for everybody, right? They're not designed for the $250,000 house. In fact, a lot of those down payment assistance programs, they have caps on the amount you can spend. They're not going to give you, $5,000 so you can go spend 300.
Yeah,
it doesn't work that way, So first time home buyer, not that many programs that are designed for them.
So the biggest thing people can do is work on the credit. Get your secured card. Make sure you're paying everything on time. Get your credit up. Attempt to qualify for a conventional. I mean, that would be ideal, right? Like if you can qualify for a conventional, your interest rate's going to be better, your payments will be better, et cetera. So the biggest ones is clean your credit up. Pay your stuff on time.
Yeah, drive your credit up as high as possible. Save some money. Okay. Make your payments on time. That's what it's a lot of people say, I don't have credit because I pay cash for everything. I won't, unfortunately that's not a good thing to do in life, right? Because especially in this day and age, everything is cashless, right? Yeah. So we want credit, but use it smart, right? Just because you have credit cards doesn't mean you have to go out and spend, on brand new Nikes or buy jewelry. You're using it to establish credit to put yourself in a better position down the road. Okay. Pay them off at the end of every month. Just because you have available credit doesn't mean you spend it, right? Spend it and then pay it off at the end of the month, just like a debit card. Kind of like you swipe your debit card. You're only going to swipe until you have none left, right?
Yeah.
Use what you can, and that's it, right? Keep doing that. Drive up your credit score. Make on-time payments. Do not close credit cards. Once they're open, leave them open. I don't care if there's a zero balance. The longer you have it, the more valuable it is to the credit report, to the credit score, okay? Yep. If you close it out, you lose that history. Part of that algorithm is history. Okay. And that's a big part of it.
Wow. Yep. Fascinating. So if my audience wants to find you someplace on Instagram, Facebook, wherever else, where can they find you at?
Mortgage Guy Dave.
Mortgage Guy Dave.
That's it. Mortgage Guy Dave. Pretty simple.
Yeah, and I got this here. I know Dave's going to start putting some more content on there. Dave, the Mortgage Coach. You can find him on YouTube. He's got a channel there. We're going to be pumping more content on there. Dave, the Mortgage Guy on Instagram. Was that Facebook as well?
And TikTok. I got it all now.
Man, he's ahead of me on there. I got the channel, but he's got all these other platforms. And anything else you want to add before we get out of here? Anything you think they need to know? And
every single person is different, right? Every single person. Okay, so it's a unique situation for everybody, right? So what works for one person may not work for the other, right? So we're trying to build credit. Sometimes we're trying to build credit, and we've got to remove some bad debt first. Maybe they have collections. Maybe they got medical collections. I mean, there's so many different variables to this. Call me up.
Yeah.
Okay. Let's have a conversation. Okay. We can get it. We can get access to your credit report, right? I don't have to pull it. Go to freecreditreport.com. You can pull it yourself, right? Freecreditreport.com. I just threw that company a plug, right? So pull your own credit report.
Yeah.
And then you can see what's on it. And if you need someone like myself to evaluate it, give me a call. I don't mind. Throw me an email, a text, be like, hey, I just saw your video with Anthony. Can you look at my credit? I want to see how I can, what I can do to build myself for the future. I tell this to people all the time. Maybe it's not that you can't buy a house. Maybe you just can't buy one right now.
Yeah.
Okay. But the future, hey man, it's there, right? Time heals wounds, especially with credit. You had some bad times years ago. We can get out of that. It might take some time, but we can get out of that, right?
Yeah, I mean, I really like that you're saying this because our last few deals, there's a couple of them where one guy was retiring and he wasn't going to have income afterwards. So we worked a way around that to use the cash that he had in the bank, and there was a whole process there. I like that because I think a lot of people don't think they can get a house, and they just, my credit's too low, or this or this or this. So, yeah, I mean, call me. I can put you in contact with Dave. I don't want to say there's always a way, but a lot of times there is when people think that there's not one.
Mortgages is complex, right? It's really easy when it's simple, right? I mean, that's just the way life is. When something's simple, it's easy, right?
Yeah.
But most of the times it's not. And the difference between, as humbling as I wanted, as I am, the difference between great and exceptional is just thinking outside the box, right? And in this business, we have to, because everyone's different. Everyone's got a different income. Everyone's got a different type of asset. Everyone's got a different credit score. Everyone is different. Everyone's got a backstory, right? So the simple ones, yeah, I mean, we should be able to do those loans no problem, right? But when, it gets a little, creative, we got to get creative, right? So that's the difference between my team and everyone else, because we get creative. We're not just going to put you to the side. We're going to figure out the best course of action, whether it's through the next 30 days or even a year, right? I've got clients that I know that are going to be ready in a year because we put them on a plan.
Guys, Dave has jumped through so many hoops for me. It's ridiculous. And in situations that I didn't think it was possible. Last question, and I'll let you go because I get this question a lot. If somebody has already been pre-approved through a big bank or through their credit, wherever, and they come to me and then I ask them, hey, have you talked to somebody? Yeah, it was a while back, but it was through them. And I know they're probably not getting the best rate. If their concern is, hey, I don't want my credit to be dinged again, if Dave's just going to pull my credit again, isn't there a time period in there that somebody can reach out to guys like you that it's not going to hurt their credit? Does that make sense?
Absolutely. Yeah. So every time you get your credit pulled, it's considered an inquiry, right? Okay. But you can have your credit pulled as many times as you want in a 30-day period. And it's considered one inquiry. Okay. Now, why is that? Well, you shouldn't be stuck with the first person that interviews you and you interview them, right? You may call them up and say, you may not like me. And I pull your credit and be like, you know what? I'm just not clicking with Dave. I hope that never happens, but it could, right? Yeah. So if you don't like the person you're dealing with, you should have every right to go to another person or shop it around. So the credit bureaus have came up, and I don't know what year this was, said, we're not going to hit them every time. Let's give them a 30-day period. But it's got to be for the same reason. Now, if you go and pull your credit for mortgage purposes from a financial institution, okay, and then tomorrow you go to Honda, and then the next day you go to Best Buy, okay? Well, those
not the same thing.
Not the same thing, right? So you're going to get 3 separate inquiries on that. Now, will it affect your score? Not really. People think, I hate the word ding. I tell people stop saying ding.
Oh, I use it all the time. I use it, yeah.
I get a ding. No, it's not a ding. It's an inquiry, right? It's such a negative word, ding. You can have when I pull people's credit, they're like, oh, my score didn't even move. Yeah, because all you're doing is having an inquiry, right? To see.
And the misconception is it's going to go down 20 points.
It's such a misconception. Now, let me pull your credit, then go to Cadillac, then go to Best Buy. Well, you might see a couple point drop, right? So
yeah,
but
it's not that big of a deal. I mean, people freak out about it. They just tell me, no, don't pass my name to him because it's going to hurt me.
If your credit score drops by 20 points, it's not because you got your credit pulled. It's because of something different.
Stupid move you made.
Yeah, you ran up a high balance, or you were late on a payment, or you have a collection, or something just got reported in the same time period of that credit inquiry. Yeah. That's why, right? A lot of the times it's because of high balances, right? Remember, and I know we're short for time. So the credit bureaus, like I said earlier, are data collecting services. That's all they do is collect data from the creditors, the American Expresses, the Discover cards, your car payments. All those creditors send their data once a month to the credit bureaus. Now, let's say, and they're all different times. So maybe Amex might send their data on the 6th of the month. Discover might send it on the 10th of the month, and then so on and so forth. Let's say they sent their data on the 10th and you paid your bill on the 11th. Well, they're not going to see that until the next month. So whatever data they have on the 10th, that's what the credit report will be for the next 30 days. Mm-hmm. Because they're not pulling that data for another month.
Interesting.
Okay? Yeah. So every credit card and every trade line and every creditor is different how they send their data to the credit bureaus. So sometimes it's timing, right? So you're like, whoa, my score went down 20 points. Yeah, you got $8,000 in your Amex. I paid that off. All right, so next month, you'll see that because that's when they'll report the data.
Yeah, and I'm glad you went into this and explained it because I obviously there's so many misconceptions around lending, the process, credit scores, everything. So I guess the takeaway from that little snippet there to my audience, anybody watching, is talk to Dave. Like, let's just talk to a lender. Whatever your situation is, let's lay it out there. It's not going to ding your credit. We're going to make sure that you're safe and find the very best path possible with whatever you got going on there. So I'm glad you brought that up, and it shed the light on it. Like, it's so different. Like, everybody's so different. And that's one of the things I've learned through being in real estate and talking to you, is that every situation is different. And just when I think somebody can't get approved, they're approved, they have a new house, and they're moving in, and it all works out. So anything else before we shut it down? I appreciate your time here, man.
No, we could talk about this all day. I love this stuff. Like, this is what I do, and I don't mind talking about it. But if anyone has any questions, concerns, my phone number's on the bottom, my email's on the bottom. I'm always accessible. So text message, phone call, email, it does not make a difference. You could, DM me on one of my social media platforms. Someone's always on the other end to answer it. We got a team working for us. So that means we have a team working for you.
Yep.
But yeah, anything real estate, go to Anthony, loans, go to me, and we got you covered.
Awesome. Dave, thank you for your time. Guys, I appreciate everything. If you have any questions at all, hit me up, hit Dave up. We're going to be doing a series like this and more questions that come up, and we're going to come on here and answer them for you. But thank you, everybody, for your time. Dave, thank you. Y'all have a wonderful week. Till the next video, take care.